About the market and this push to record highs with Vital Knowledge founder Adam Crisafulli and Carson Group chief market strategist Ryan Detrick. Guys, welcome. Ryan, this market's broadening out, and we didn't get any kind of freak out with these Fed minutes. What does that tell you about what's to come post mid-February?
Yeah, John, thanks for having me back, and good afternoon, everybody. I mean, listen, come on for a while, probably like a lot of other guests, and expect to see broadening out. It's happening, right? Year to date, 11 sectors, all of them higher. Year to date, 7 sectors are doing better than the S&P 500 here, John. You know, I mean, it's been a heck of a run. We know 2 years in a row up 20%. Now we're up, well over 4%, almost 5% so far this year. It's a bull market. The way I learned it a long time ago, surprises in a bull market happen to the upside. We've been saying for a while we're in a bull market, and now that baton's being passed around, I mean, tech's up, yes, but tech is actually lagging. It lagged last year. People don't remember that. Tech did worse than the S&P last year, not by a lot, but by a little bit. And we're seeing that again. But now we're seeing that rotation, lifeblood of a bull market again. Rotation, John. It's nice. It's nice for investors, I think, to finally have a diversified portfolio that is doing well. To see all the groups doing well, it's a great sign.
Adam Crisafulli, speaking of potential broadening, we've got Toast and Klaviyo reporting here in overtime. And when I think of these two names, I think about digital payments and marketing. I think about potential omni-channel and the idea that data is driving loyalty and business in a new economy. How important are these stocks, you think, to investors who are watching how AI gets integrated into the workings of business?
They're definitely both critical companies. Fundamentally, they're each performing well. It's just a question of valuation, kind of back to the broader theme of broadening. I think really what you're seeing is a reversion on the valuation front for some of the very high multiple stocks, like pretty much a lot of the names up on the screen right now, Carvana, Toast, Klaviyo. Those stocks have extremely elevated multiples, and you're seeing some of the cheaper, relatively cheaper parts of the market start to catch up a little bit in terms of multiple expansion. And that's really what you're seeing. So fundamentally, investors will be watching them very closely for a sign, for Toast, for a sign of how the restaurant market's doing. Klaviyo gives some insight into small business. But it's really, I think, kind of about a multiple equalization between really two barbells of the market.
Ryan, it's interesting because we're seeing the S&P at record highs. We're seeing the NASDAQ 100 at record highs. The DAX hit a record this week, and so did the Stocks Europe 600 index. But the other thing that's been trading at record highs is gold. Do you buy in at these levels, or do you feel like that trade has already gone long in the tooth?
Specifically with gold, we actually added some gold to our tactical models for our Carson advisors back in March of 23. Added a little bit more gold when gold pulled back violently during the right after the election when the dollar went higher. So listen, we know why gold's going higher, right? The indecision, central banks are buying. But I'll tell you also, I think the U.S. dollar is making a major peak, if not already made a major peak. Coming into this year, everybody said the dollar had one way to go that's higher. We know when everyone's thinking alike, someone isn't thinking. We think inflation's getting better. The Fed's going to cut a little bit more than being priced in, meaning the dollar goes lower. So to us, if you have a 60-40 portfolio, that 40% part, you might not want to have all fixed income. You might want to have 3 or 4% gold. It makes sense to kind of be hedged. And again, gold, we think it'd do better in bonds last year. It did. We think gold will still do better in fixed income as the dollar goes lower and some of that indecision is still out there. We're still bullish. We're still overweight equities. Let me be very clear. But it makes sense to diversify your diversifiers, what we say. And gold, and one more quick one on this, we actually added some long-term treasuries for the first time in multiple years. All right, we didn't want to touch that. But we think rates are going lower. So maybe have some treasuries, have some gold, still be overweight equities. That's how we're looking at portfolios here.
Interesting. Adam, I want to get your thoughts on that, especially some of the gyrations we have seen in currency markets and the bond market. I mean, tariff talk has sort of been dictating a lot of the moves, or at least some of the moves, I guess I'll say. And yet, here in the last couple of days, investors seem to be shrugging the latest comments we've been getting from President Trump off, at least for now.
Yeah, no, and I think in the minutes today, there was a very critical component about, so the focus for the Fed has been on the funds rate, but the quantitative tightening process looks like it's nearing its end stages. And so to the extent they shut that off, that'll be another big tailwind for treasuries in addition to further disinflation. And so that's something else to keep in mind. That's really why you saw the rally this afternoon in equities and treasuries as well. It was that quantitative tightening language within the minute. So you have the funds rate plus the quantitative tightening process. Both of those are heading in a direction supportive of treasuries, pushing yields lower.